rates. The Federal Inland Revenue Service wishes to notify the general public on the prevailing withholding tax rates applicable to relevant transactions, as can be seen on your screen. In line with the provisions of extant tax laws, every taxable person, this includes a body corporate or unincorporated, a ministry, department or agency of government, a company, firm, any statutory body, a public authority or any other institution, organization and establishment or enterprise making payments for the respective transactions is, by this notice, reminded that A. To withhold the tax at the appropriate rates, B. To remit the tax withheld to the relevant tax authority on or before the 21st day of the month following the month in which the tax was withheld or the duty to withhold arose, and C. That any person who fails to comply with the legal requirements to withhold tax or having withheld fails to remit the tax commits an offense and liable to penalty and interest prescribed by the relevant tax laws. Signed, Muhammad Nami, Executive Chairman, FIRS. It is pertinent to point out once again that, as indicated on the table, withholding tax can arise in corporate transactions as well as transactions involving individuals and enterprises, where one of the parties is a corporate body or a government MDA at any tier. The withholding tax is payable to the Federal Inland Revenue Service, but where transaction is between individuals, withholding tax is payable to the State Internal Revenue Service. Again, withholding tax is not a tax type on its own, but rather an advance payment of tax. In matters relating to companies' income tax, withholding tax paid can be used to offset companies' income tax liability at the point of filing and payment. It does seem now that every new day brings out a new thing in the Nigerian tax system. It is no longer news that on the 25th of May, the National Bureau of Statistics released information to the effect that Nigeria's tax to GDP ratio has moved from 6% to 10.86%. Now, another big one. The long-awaited Finance Act meant to support the federal government budget 2023 has been passed into law. The 9th National Assembly finally passed the Finance Bill 2022, and on his last day in office, 28 May 2023, then President Muhammadu Buhari assented to the bill, making it Finance Act 2023. Ardent followers of events and activities in the Nigerian tax system will recall with delight the tremendous work that the 9th National Assembly did with regard to passing finance acts that will provide necessary backing for the Appropriation Act consistently from the year 2019. Yes, the 9th National Assembly passed 4 finance acts to its eternal credit. Even more delightful and more commendable is the fact that the 9th National Assembly ensured that both the Finance Act and the Appropriation Act were passed before the end of the preceding year or very early in the month of January of the year of appropriation. One intriguing feature of the Finance Acts passed since 2019 is that, unlike the Appropriation Act that will carry the year of appropriation, the Finance Act always carries the year before. We sought answers to this at the material time without any satisfactory answer, so everyone lived with it. And so, 2019 governed 2020 appropriation year and on like that. So, for the year 2023, we were expecting Finance Act 2022. This did not happen until May 28. It also bears pointing out that this Finance Act 2023 is the only one since the Finance Act came into the system in 2019 that will be coming out this late. This is mid-year already. So many questions, so many answers. To shed light on the Finance Act 2023 and matters arising, we have as guests on this program Mr. Albert Folorunsho, one of those that can be considered an active participant in putting the annual Finance Acts together. Mr. Folorunsho, thank you for joining us on Tax Matters.
Thank you, Amaka, for having me.
So let's go straight to business. Okay. Now, the Finance Act 2023, which will support the Appropriation Act 2023, has come out 5 months late. What seems to be the problem? What caused the delay?
Okay, well, government and National Assembly, the way they do their things, of course, when the bill was made public, there are certain issues that at the public hearing, a lot of entities and groups protested, and of course, eventually the bill was harmonized and forwarded to the president for assent. But of course, because of some of the issues that were included in the harmonized bill, and then some of the protests, the fact that not enough engagement was carried out, blah blah blah, all are those that actually delayed the signing into law of the act. But again, you notice that this is an election year, and so everyone, all the politicians were busy. So after the amendment and the consultation, the bill had to be sent back to the National Assembly for review and sending back to the president again. And you will observe that, in fact, the act was signed virtually the last day of the former president.
All right, thank you very much, sir. Like they say, better late than never.
Yeah.
All right, so now we've noticed that this act has been cited as the Finance Act 2023. Why the jump? We didn't have Finance Act 2022.
Okay, so the National Assembly always designates the act or the bill the year they pass it. Okay, so since the act was passed in 2023, automatically it has to be Finance Act 2023. Usually the previous ones were passed in December, and then they are designated as the Finance Act of those specific year. But now this has been passed in 2023. The most significant issue for me for this act is the fact that it states that it takes effect from 1st of May, and though it was actually signed into law, on the 28th of May. So companies will definitely want to wonder when exactly will the law be effective. And but of course, FRS has been very proactive. Circular is already going around giving guidelines as to the implementation. And from what we have seen in that guideline is something that businesses will be happy about, particularly for corporate tax, education tax, that it will only affect account that are submitted after June. So if your accounting year end is June 30th, 2023, the provisions affecting corporate tax and education tax in the law will not be applicable, because it will deem to take effect from 2024. So only returns that are filed in 2024, which will be on your 2023 account, will be applicable. So clearly, your 2022 accounts are not, financial statements are not affected by the law. But of course, they have also said that for transaction taxes like maybe collection of stamp duty and value-added tax, the FRS has also given enough time for businesses to be able to relate with the provisions, and they have said that it will start from the return that will be filed in July based on your June 2023 transaction, which is a good thing, and we hope that that will also be sustained, so that one way or the other the Finance Act is not implemented in, does not have a retrospective impact on businesses. We believe that will be continued by the regulatory authority, FRS, and the states, Internal Revenue Service.
Very commendable. Now, sir, kindly take our viewers through some of the major provisions of this Finance Act.
Okay, most of the taxes, extant laws were, affected by the law, even though it's not as comprehensive as what we used to have. Starting with Capital Gains Tax Act, there's 3 specific provisions. But one is the fact that digital assets, when you dispose of digital assets, the gain on that disposal will now be liable to CGT at the rate of 10%. That is if you are an investor. But if you are trading in those assets, of course, like any trader, you'll be liable to income tax. Okay, for a company, you'll be liable to company income tax, while for individual trading in those cryptocurrency and co, they'll be liable to company income tax, while individual will be liable to personal income tax. The second amendment is the fact that with effect from this provision, when you make loss on disposal of an asset, okay, the loss can now be set off against gains made on disposal of asset of the same type. Okay, so which means if I dispose of a property and I make a loss, the loss can be set off on any gain I make on the disposal of another property. Okay, and where there are no gains from which the loss is to be deducted, it can be carried forward for as many as 5 years. That is a very good development, and it aligns with international best practices. Again, we have disposal of, the disposal of shares, which came into back into the law, okay, in the last Finance Act, which was the fact that when you dispose of shares that is worth 100 million and above in a particular year, CGT will apply if you make any gain. Okay, but of course you can avoid such tax if the if the disposal proceed is reinvested within the year. Okay, but what was not in the original provision or the previous provision is the fact that the provision relating to rollover relief, okay, which was the basis for giving relief where an asset is disposed and the process of sale is reinvested in the acquisition of another asset of the same type. Okay, so that has now been, made available for or included for shares, and that also remove, a gap in the law where taxpayer will have taken some advantage. So, which means our tax authority are also being proactive in looking at the provision of the law. The second provision is company income tax, and specifically you see that the major one on company income tax is the one on section 14 that has to do with income accruing to non-resident entity engaged in shipping and air travel. Okay, so the law had said that they want to really ascertain how much those non-residents are making in terms of their revenue in Nigeria. And some of the things that they have requested them to do before they can obtain tax clearance in Nigeria is that they must submit the revenue statement, okay, which will be certified by a director of the company and an auditor of the company, and such revenue statement will be supported with invoices issued by those entities, and also provide evidence of income tax filing, and then of course their tax clearance certificate, for them to continue operation in Nigeria. I think this seems to say that maybe the government feel that most of those non-resident entities engaged in shipping have not been compliant with tax, and for them to operate in Nigeria, they need some approval. To obtain those approval, they need tax clearance, and so government wants to be sure that they have paid their taxes before the tax clearances are issued to those companies. Several other changes include the removal of investment allowance. From 1990, when you incur expenditure on plant, machinery, and equipment, companies were eligible to claim additional allowance of 10% on the cost of the on the cost of the expenditure incurred. Okay, so government is trying to cut back on some of those tax expenditure, and so investment allowance has been removed. Again, rural investment allowance, which was applicable to enterprises that are set up in rural area, depending on how far away from the city centers and all that. So the expenditure you incur to provide electricity, telecommunication, and power, whatever, and roads, okay, to those rural companies, okay, while enjoying, investment allowance, but that has been removed. That was never a serious provision. Another provision that is significant, which has now been taken out, is the fact that income in convertible currency accruing to hotels from tourists, okay, were hitherto exempted from tax. So when you generate funds from tourists by hotels in Nigeria, you know, such funds were expected to be kept in a pool that the hotel owners can use to expand, you know, the hotel business so that they can attract more foreigners for tourist attraction. Okay, that is also being removed. Okay, and but of course, if you already have a fund and you have made provision in those funds, you can still utilize them until the fund is fully exhausted, at least for the next 5 years. Another provision that came up in this act is the fact that upstream and midstream gas operation companies, okay, are now to claim capital allowance like agricultural and manufacturing companies. That is, the restriction of capital allowance to 2/3 of assessable profit will not apply to them. It was just something that is necessary for clarification, okay, to be sure that they also are to enjoy full capital allowance without any restriction.
This interesting discussion on the Finance Act 2023 will continue in a subsequent episode. We have reached out to the authorities at the FRS, tax professionals and stakeholders for broader perspectives on this all-important act. Watch out for it. But in rounding off this episode, we want to conclude our feature on the tax to GDP ratio matter. Chief Mark Anthony Dike is a past president of the Chartered Institute of Taxation of Nigeria. Mr. Dike, thank you for joining us on Tax Matters.
It's a pleasure. You're welcome.
So the tax to GDP ratio of Nigeria is now 10.86%, and this is worth celebrating. Now let's begin this way. What really is the essence of tax to GDP ratio? What does it say about a country's economy, and what does it mean to the ordinary man?
High tax to GDP ratio is a measure of development, is a measure of well-being of the citizens. It does not necessarily mean, lower taxes per se, or even higher taxes. But then, countries like Norway, a country with a small population, maybe less than 10 million, but the tax to GDP ratio is very high. Students also pay very high taxes, but then they get value because education is free up to university level. There is good water, free education, free health care. So you pay higher taxes, you get a lot of the things that the state should provide for its citizens. So I think what is being called increase in our tax to GDP ratio is actually not an issue, seriously speaking, because what government has done, especially the Bureau of Statistics has done, is to take a step back. Are we actually capturing the various taxes that are paid? Because what people take as taxes paid are those that come directly into the coffers of the various governments. But then they don't reckon with the tax waivers that are given. Remember, with a Finance Act, businesses make below particular threshold 20 million are exempted from paying, tax. And so that is even beyond individuals. And you talk about, when you don't pay the tax directly, you pay it indirectly in some other ways. For example, those businesses that are exempted from paying tax or even charging, VAT, they pay, indirectly. Because one, they have employees who they may have to pay the taxes for. Even vertible goods, they buy. Remember, they buy. And if there are goods that are liable to VAT, they pay the VAT. And therefore, the only thing that you see is that there is no output VAT when they sell, but they paid input VAT when they bought the goods for resale. And even when they now sell those goods, they did not charge VAT. It doesn't mean those that buy the goods from them, if they are above the threshold that are exempted, those ones will also have to charge VAT. And therefore, it is not absolutely correct to say, yes, because some people are exempted. There's some, spiral effect that also triggers tax that is paid. So what the Bureau of Statistics has done is actually to take a look back and try and bring in, factor in all those exemptions and waivers into the stream, and then be able to now say, yes, this is supposed to be a more credible tax to GDP ratio for Nigeria. But we expect it to even be more than that, because averagely, most of our East African countries are talking about 15%, some are already going to 20%. And if you now move further, you're not talking about the developed world, you're talking about 30 or more percent.
Now, in calculating this tax to GDP ratio, what factors and indices do we put into consideration?
Incomes. And income, I mean that in the generic sense. This is incomes which individuals, earn as salaries, as profits, salaries in terms of employees, profits in terms of businesses, whether limited liabilities companies or limited liability companies, partnerships, sole proprietorship, all the income that they earn. And then, of course, businesses, beyond profit, they produce goods and services. We're not talking about profit now, we're talking about anybody who produces expects to sell. So we are talking about the volume of sales, not profit for businesses. But for individuals who are in employment, the income from employment is what goes into the GDP. But for businesses, it is the total volume of production and economic activities, their turnover is what, these are all the things that are taken into account. And then, of course, like you said, when you have waivers and exemptions, you have businesses, because, like for instance, healthcare, medicals, for instance, those things are VAT exempt. Sometimes, if you are looking at volume of sales through the VAT window, you may see that those ones are exempted, may not, because they are not VATable. You put them aside. But when you're not talking about GDP, everything is taken into the, to the basket. And whether it is exempted from income tax, value-added tax, everything is taken into account.
Now, this new ratio is based on computations from 2010 to 2021. Now, why do you think 2022 was not included?
Well, it depends on when, statistical survey is done within the context of a period. The result is out now. It depends on when they carry. Remember they will go to the field, gather the data over time, then come back and profile the data. So at the time they did so, maybe this thing that you're seeing now was done last year, rather than this year. This year, 2022 you're talking about just ended 5 months ago. We're just early in the 6th month after 2022. And you can be sure that this thing was done last year. Therefore, that's my own, understanding and the way I will appraise it. So realistically, in my estimation, this survey must have been done last year, and therefore the best was to benchmark it to 2021. I think there's absolutely no doubt, in spite of the rebasing that we have had, that I pushed it up to 10% thereabout. And I remember last year or so, at the Federal Capital Territory IRS, Federal Revenue Service, I was asked to talk about the issue about tax delinquency. And we have to give an array of tax GDP ratio across many African countries and even beyond. And I've already given an example of now where is it, an oil producer like Nigeria, small population of less than 10 million, but their tax to GDP ratio is very high because the people pay high tax. Why are they paying high tax? because government needs more tax to provide those public goods and services. Education is free up to university level. There is free Medicare. Nigeria relatively, you may say the taxes are not high, but then even the little that is paid, what is it being used to? Whereas if people paid tax genuinely and the government applies the tax genuinely for provision of public goods and services, then people should not complain, paying tax if they see the benefit for the taxes they pay.
Mr. Anthony Dike, thank you very much. We really appreciate your time.
My pleasure.
Nigeria on the move. With our collective efforts, we'll build the Nigeria of our dream. Thank you for watching. See you next week.